So we're absolutely delighted to have Brad Hathaway here with us today. Brad Hathaway is the managing partner of Farview Capital Management. Before founding Farview Capital Management in 2011, Mr. Hathaway worked for 4 years at the J. Goldman Company, a New York City-based hedge fund. At the J. Goldman, he worked as an analyst and a portfolio manager on the firm's value team. His role there included sourcing and analyzing investment opportunities and managing a portfolio comprised of global securities from multiple asset classes with a focus on U.S. publicly listed equities. Prior to J. Goldman, Mr. Hathaway worked for 3 years as an analyst at Tocqueville Asset Management, where he discovered and researched global long and short equity investments for the International Value Mutual Fund and the Global Partners Hedge Fund. Mr. Hathaway graduated with a bachelor's of arts in political science from Yale University. Thank you for joining us today, Mr. Hathaway.
Thank you for having me. I look forward to chatting.
Excellent. So why don't we begin by you talking a little bit about your investment philosophy?
Sounds great. So my investment philosophy is kind of a merger of both the kind of long-term value orientation that I had from my history at Tocqueville. Tocqueville was very traditional, kind of Graham and Dodd, long-term value. And so I took that and kind of that idea of time arbitrage, and then I added to that a little bit more of the special situations component that came from my J. Goldman experience. So J. Goldman was very focused on why is the security mispriced, who is selling it to us, and what is our edge. And so when I launched Farview, I wanted to kind of put those two things together. One is, so on the one hand, I think time arbitrage and looking for things you think are much more valuable over the long term is one of the better ways and more interesting ways, in my opinion, to make money. But also, I think it's really, really important in every situation to understand, why is the security mispriced? Why is the market giving you this incredible opportunity? Because while the market is not always efficient, it is frequently efficient. And so if you can't understand who's on the other side of the trade, then the likelihood is you're missing something.
Yeah, absolutely. That makes a lot of sense. And what types of special situations intrigue you most, like spin-offs, merger arbitrage, equity stubs, etc.?
So again, my investment philosophy is kind of longer term. And so I run a concentrated portfolio of, kind of 10 to 15 names, and I'm looking for things I think are materially mispriced over a multi-year time horizon. So that leads me more to the potential special situations that could be multi-baggers. So it could be a spin-off where there's, a really attractive underlying business that's been mispriced or misunderstood. Post-reorg equities are sometimes an interesting scenario, but generally I'm not as interested in things like merger arb that are more kind of shorter term focused and kind of smaller absolute return focused.
Yeah, and one of the spin-offs you invested in the past is the Marriott spin-off. Can you describe a little bit what your thesis was on that and sort of the thinking?
Yeah, so we're going back into the well there. So Marriott was interesting because the timeshare business had a very kind of mixed reputation on Wall Street at that point, but it was a very interesting business in that there were some much more stable streams of cash flow in the kind of business that people were like, oh, well, it's just selling timeshares. Who wants a timeshare? But some of the management streams of cash flow were much more stable and very high margin and attractive. So that was compelling. And also the way they structured the spinoff, one of the concerns with the spinoff is you don't want to end up buying a garbage barge where basically, the management team is trying to offload a bunch of liabilities onto public markets investors. And this one, if you looked at the kind of the Marriott Vacation spinoff, it was actually set up with a clean balance sheet and a good chance for success. So it seemed like it was interesting in that it had a solid foundation and also potential for mispricing because I think there was a fundamental misunderstanding of the underlying business.
Absolutely. And can you detail another another spin-off thesis you had?
So one of my favorites, and if we want to go way back in the day, is a company called Veripos. So it was a Norwegian spinoff from there's a Norwegian blue chip called Subsea 7 that does basically oil services and is a member of the main Norwegian index and is a kind of a really very, very much a blue chip stock. In I want to say it's 2012, I believe, they spun off Veripos, which was effectively a signaling business for positioning of offshore rigs and offshore vessels. And it was a tiny company, a couple $100 million market cap out of a multi-billion-dollar Norwegian company. And one of the fascinating things about that one was the prospectus effectively did not come until within a couple of days before the company was listed publicly. And so there was there were so many interesting dynamics at play in that. One, there was a massive size difference. So you had a lot of people who owned Subsea 7 who couldn't own Veripos. And then there was a huge information gap because the basic financials of the company didn't actually exist in the public markets until very close to the day it came public. And so what I loved about that one was I actually did my diligence process in reverse. So I was speaking with customers and competitors before I actually knew what the income statement looked like. But it was very clear to me early on that this was a very attractive, very sticky business. It was a relatively small cost for these extremely expensive offshore vessels. But if they didn't have the precise positioning that Veripos provided, then they had the potential to wreck, for a very small amount of money to wreck a, multi-$100 million vessel. And so it looked like it was a very sticky stream of revenue, a very attractive business. And so I got very comfortable with the competitive position. I got very comfortable with their growth opportunities. And then literally the last thing I did was build my financial model. So it was funny. It was part of the reason why I love being global is it gives you those opportunities. Wherein I feel that US spinoffs are often very picked over. There are so many hedge funds who have read Joel Greenblatt and are very interested in US spinoffs. The global market can be a little more, a little less picked over and a little more inefficient, I would say. And so, Veripos, I didn't have to understand anything about Norway specifically. I didn't have to understand anything about, some local culture. This was a global business. A significant portion of their business was in the Gulf of Mexico. It could have easily been listed in the US, but because it was listed in Norway, the competition looking at that kind of spinoff was much, much lower.
Yeah, absolutely. Thank you for sharing your analysis with us. That's very intriguing. So you're in a pretty concentrated portfolio, and it seems like geographically your investments are sort of split across the US, the UK, Germany, and Sweden. US, UK, Germany, those are, huge economies. Why Sweden, of course, they also have a lot of pretty interesting companies, but is there any reason why Sweden in particular, it's a much smaller economy there, of course. Is that a place where you tend to regularly find opportunities, or did it just end up happening that way?
So actually, I think the Swedish capital markets are fascinating. Sweden has an incredible combination of really great companies. If you think about some of the companies that come out of Sweden, Spotify, Klarna, some of these real world beaters have come out of Sweden, and they have a very developed capital markets infrastructure. So there are constantly transactions and M&A and spinoffs that allow for opportunities. And so I find, Sweden has, a combination of great companies, a relatively mature capital market, but an investor base I think is very savvy, but generally, I think less comfortable with uncertainty than I would say US investors are. So some of my investments in Sweden have been things where I'm very comfortable in where this company will be in 3 to 5 years, but I'm a lot less certain as to where it will be in the next 12 months. And I find that there's sometimes an opportunity there in the Swedish capital markets, because that's not, and I'm generalizing here, but that doesn't seem as attractive to the local investor base.
And there's a lot less companies. There's still a significant amount, about 1,000 in Sweden. Do you sort of do sort of the old Buffett routine of just going sort of A to Z and looking through all these companies, or do you sort of filter ones out with some sort of mechanical screeners or keyword screeners, or how do you examine these different companies?
So I'm not really a believer in quantitative screeners anymore. I used to do that a fair amount, but I just think that right now anything that shows up really inexpensively in the current numbers is, generally it's been arbed out by machines. And if it hasn't, there's a reason why. So I am very leery about something that looks very statistically cheap unless there is some reason that I can understand as to why it's I really have to understand why that one is mispriced. So I don't do the A to Z thing. I don't have the time, frankly, but I do love keyword screeners. Is something you mentioned. So I love using both Google and Bloomberg to put together combinations of keywords, and I have a few hundred that create a very broad funnel of potentially interesting opportunities, and things like I'm looking for things like transformative M&A or spinoffs or an inflection point for the business, or one of my favorites is the search for the term hidden gem in management transcripts, because maybe you find a part of the business that is really attractive that has been overlooked by the public markets. So those keyword screens, I get a few hundred hits on those every week, and I generally spend some time cutting through them very quickly, and that's the Sam Zell, the quickest no in the West. I'm looking at all these things and trying to kill them within a couple of minutes, and then trying to find, if I find a few, there's the chance that I find something that's a little off the beaten path that people haven't seen before, that could have some interesting opportunities for further research.
Yeah, absolutely. And one of your massive successes in the past was Del Clima. Can you discuss some of the other, let's say, very successful investments you've made in the past and how you found about those companies?
I'm very impressed. When you asked for all my letters, I actually didn't think you'd read them all, but you clearly read them all. So well done on that. So Del Clima was a really interesting example. So they were an Italian, basically air conditioning and heating firm that was spun out of the Italian kind of, I guess, kitchen appliance conglomerate DeLonghi. So a lot of people might recognize the DeLonghi espresso maker in their house, in kind of they've seen in hotels or in some homes. And so Del Clima was at the beginning very much considered kind of the less attractive part of the business when you looked at the consolidated financials. It was relatively small compared to DeLonghi, and it wasn't that profitable. But when you dug a layer deeper, what you actually found was that Del Clima was two businesses. It was an incredibly attractive air conditioning business that was really the leader in Europe in high-end air conditioning, and a loss-making radiator business that was frankly dragging down the consolidated results. So in the research process, I called them up, and at that point, they didn't have IR, they didn't have a CFO. And I spoke to the CEO directly, and I found out that he was going to Chicago for a big air conditioning conference. And so I flew to Chicago, met him for breakfast, and he is one of the best managers I've met. He, within an hour, it was so clear that he had this incredible vision for how he was going to grow the air conditioning part, stem the losses or sell off the radiator part of the business. And he was just clearly a manager that I wanted to back. And the incredible thing was, then we decided to share a cab to the conference and got stuck in a couple hours of pretty horrific Chicago traffic. So he spent the next 2 hours basically educating me on the air conditioning business. And I left that meeting being like, this is a manager I want to back. This is an incredible air conditioning business that I think has a significant amount of value. And so that gave me a fair amount of confidence to take the position. Then continued to do diligence, and this is still a diligence call that sticks in my head. Is I spoke to the head of France for Carrier, which is the big U.S. air conditioning company, one of their European competitors, and he said to me in this heavy French accent, he goes, "Del Clima is one of the few companies I actually respect." And so again, it was very confirmed that this was the air conditioning unit of this business was an absolute gem. So made the investment early on. It was a good size position. And then as they actually kind of proved out the thesis and they started to stem the loss in radiators, air conditioning continued to grow, that was actually an example for me to increase the position. And this was actually a huge learning point for me, because historically, I'd been a tried and true value investor, wherein I'd buy things, if things went down, I'd buy more. If things went up, I'd sell. And I wouldn't I was very quantitative in that focus. But with Del Clima, I found myself wanting to buy more above the initial upside price I had when I first put on the position, because the company had improved so much by that period. And so that was a huge lesson for me of the idea of, not being as anchored on what the chart looks like and, kind of what price I'm paying relative to the initial price I paid. And I credit that experience actually as being a huge learning opportunity that's opened my eyes to it, giving me the opportunity to buy a lot more different positions. To finish the Del Clima story, so eventually, a couple of years into the position, Mitsubishi Electric, the Japanese company, ended up acquiring Del Clima, and I still follow Carlo Grossi, who's the CEO of Del Clima, on LinkedIn and Twitter and all these things, and he's an incredible CEO, and I miss getting to chat with him, but I'm happy that he seems to be in a good home.
Absolutely. And can you detail another one of your past successes?
So one of the other ones that's also kind of that was interesting was a company called RMR. So RMR is a management company for basically some externally managed REITs. It's run by the Portnoy family out of kind of the Boston area. And the RMR REITs have a little bit of a mixed reputation, but RMR came public through a spinoff wherein they were giving basically tiny fractions of shares of the management company to the REIT shareholders. So there was a huge amount of selling pressure because the REIT shareholders were not natural owners of these shares. And what's interesting is also RMR, because of some peculiarity, they actually never filed the Form 10. They filed an S1, which meant that I think a lot of the people who generically scan every Form 10 actually missed the transaction initially. And so there was a lot of selling pressure. There was a structural reason why the US hedge fund community might not have been aware of the opportunity. And then when you looked under the business, the management company was actually an incredible business. Their revenues from the externally managed REITs were effectively guaranteed because they were set at a minimum of market value / cost of the acquired assets. So there was a level below which the revenues could not fall. And so it was one of the stickier streams of revenues I've ever seen. And then they had tremendous upside from if the REITs basically ever outperformed the REIT index, they would get performance fees that could be very significant. And the funny thing is, as most hedge fund investors will appreciate, is there wasn't really a high watermark on this. It was a constantly resetting performance thing. So 1 year of bad performance would almost set them up for future years of outperformance. And so it was very clearly set up as a kind of a heads I win, tails you lose scenario where the externally managed REITs were unfortunately the losers there, but the management company was an incredible thing to invest in. And so you had a situation where there was significant reason for an overhang, a significant supply of stock, significant reason why other people may not have caught it because of the S1 versus the Form 10. And then an underlying business that both had kind of significant downside protection for the contracted cash flows, and then upside optionality from these incentive fees.
Yeah, absolutely. Thank you for sharing your thesis on that. And can you also share your thesis on JDC Group, please?
So JDC is a current holding, and full disclosure, I'm often wrong. I often make mistakes. If you make an investment decision based on something you see from someone talking on YouTube, you deserve what you get. So JDC is a current holding of Farview. They are basically providing the software backend for the German insurance industry. So historically, they were what's known as a German broker pool, which is effectively a almost cooperative purchasing organization for German brokers to help them manage their relationships with the big insurance companies, and also give them some kind of back office support and technology. JDC built a very good technology backbone. And so then what they've done with that is they've taken that technology and sold it to other entities, including internal insurance companies at corporations like Lufthansa and BMW, also to banks in Germany, because the banks are trying to get into the insurance business to provide another stream of revenue. So I initially started looking at JDC, and it was clear that it had a very interesting technology that was relatively unique in the market. And they'd signed a bunch of clients, but the way it worked was it was a very long integration process. So it took a while for those clients to begin generating revenues. So it looked like there was a significant growth runway that was not reflected in current results. Fast forward now, and in 2021, JDC announced two really transformative contracts. So they signed a big German public insurer called Provinzial, which works with a group of savings banks in Germany, which are a very unique kind of German thing, but are basically a lot of the local banks in town are these savings banks. And Provinzial is the insurer for these savings banks, and JDC software is going to allow those savings banks to basically sell insurance. Then later in the year, they signed with another German public basically savings bank related insurer called DKB, which also massively increased their market. And so both of the, management has publicly commented that both of these contracts have the ability to add over 100 million euros of revenue to each of them, to a JDC group that is going to do about 140 million of revenues in 2021. So these are massively expansive contracts. Just recently, JDC announced another contract win with another German insurer called R&V, which works with a different subset of the German banking system called the cooperative banks, which opens up another addressable. So they have this huge growth runway ahead just from implementing these new contracts they've won. What is really also interesting is when you speak to people in the industry, part of the reason why they're winning these things is they actually have very limited competition. Most of their competition is either poorly capitalized and subscale, or has historically not been as focused on the insurance vertical as JDC had. So JDC has been the one winning all these contracts. In fact, they've often been winning them from, these companies have maybe piloted, like for example, some of these companies have piloted with their competitors, but that didn't work, and so JDC replaced them. So they're really in a unique space wherein they have a huge growth runway, a limited competitive set, and given the kind of small size of their historical business, they have potential to multiply their existing revenue base over the next few years. The big question is obviously execution, because again, with this kind of growth comes a lot of risk of can you actually deliver on that, and that's one of the big things we'll be watching going forward. But the amount of so this is another example of, as I mentioned with Del Clima, the idea of paying less attention to how share prices move. So I had a smallish size JDC position, and then in January of 2021, they announced the Provinzial win, which was a real inflection point for the business. And so I significantly increased my position after that win was announced, even though the stock was up materially on the day and was much above my initial cost, because that was the data point that really proved out the thesis. And so even though the share price was much higher, actually the risk reward was better because the thesis was more proven and the opportunity set was much better than I initially had underwritten.
Yeah, absolutely. Thank you for sharing your thinking on that. And what are your views on investing in China?
I never want to play a game where I think I'm going to be the sucker at the poker table. And I don't have enough China knowledge or Chinese expertise to invest in anything that would be reliant on Chinese domestic trends. There is some interest if I found a truly global business in China that I thought I could understand and that I truly understood why other investors were mispricing it. That could be of interest at some point, but historically, China has not been a focus for me.
Yeah, that makes a lot of sense. And what about Japan as well?
So I have invested in Japan. Funnily enough, when my beginning of my career when I was at Tocqueville, I was actually the lead Asia analyst for a period after the girl who previously covered Asia had gotten pregnant and hadn't come back. So I traveled to Japan multiple times, met with a lot of companies, and I met with a lot of kind of traditional value companies, textile mills and small machine tools companies and things like that. Um, I have made investments in Japan at Farview, but they are more kind of global companies. Like, for example, I owned Nintendo for a while. I no longer own Nintendo, but one of my concerns with Japan broadly is, a lot of the companies do not have a real shareholder focus. Shareholders are not the key constituency, so you don't, the returns on capital generally aren't that good. The capital allocation generally isn't that good. And taking a Western mindset to investing in Japanese companies, I think, is very, very dangerous. I also think Japan is an incredibly unique culture, and so unless you really believe you can understand the business, I think the likelihood of making a significant mistake because you have misunderstood basically, either the way it works in that culture or the way the business views itself as part of the Japanese society, I think is very high. So I think it's really important to, like, I think Japan is interesting and there's going to be a fair amount of money made in Japan, but I think it's really important to know when you have enough knowledge to make that bet, and also, avoid being in a situation where you are taking, a US capital markets mindset to a capital market that is incredibly different.
And what are your thoughts? I mean, we're starting to see some, things that weren't really seen, I think, as much in the past in Japan in terms of corporate actions. You're seeing some more very large companies that are doing some spin-offs to try and unlock shareholder value. Do you think that's something that's going to continue in the long run and things will improve and there will be more of a focus on shareholders in the long run and return on capital will generally increase? Or do you think, the difference in the long term won't be so different from how it is today?
So I do think you've started to see some positive things on the corporate governance front. The government has made some moves to try to push companies in that direction. And I'm definitely watching it intently, but I also do think that cultural norms take a while to change. And so no doubt there are some incredible opportunities in Japan that I have missed and am currently missing. There are some incredible entrepreneurs. There are some very shareholder focused management teams. There are some just incredible companies. And one of the things I think as a global investor, you have to be okay with is you're not going to get every opportunity. The point is to find those opportunities that work really well with your skill set and with your interests, I think is actually something that's, I think, underappreciated. And so, I am watching Japan intently. I do think there will be some incredible investments. I do look at things there frequently, but I would say my bar there is probably a little bit higher than it is in other markets until I see more of a sustained shift towards a real shareholder focus.
And when you were working for Tocqueville and you had more of an Asia focus and you were looking at more at Japan, were you more? I mean, Japan's very interesting because it has sort of a lot of it has, of course, a lot of things in between, but it also has a lot of companies where they're either these mega conglomerates or these companies where it's incredible. They might have like one part they manufacture and they have like 94% of the market share across the world. And it's these really unique companies. Were you more sort of attracted to those companies that had maybe like one thing, but they had a very, very sort of strong market share, or more to these mega conglomerates?
I mean, historically, I love simpler stories and the kind of, that one, as you say, there are some incredible Japanese companies that have these niche products that are, beautifully engineered and are better than anything else. And they are just, dominant players in whatever niche they're in. So that's always been more interesting to me. I think, the messier conglomerates, are generally, I don't love to invest in anything I can't understand. They're generally harder to understand. And it's funny, my history was also a lot of, we did a lot of deep value Japan, which I think without an activist mindset, it's tougher to, unlock some of the latent value of like the investment securities or the land holdings or things like that.
And you discussed Nintendo before, which was a past holding of yours. Can you discuss when you bought it, what was your thesis and why you sold it?
So when I bought Nintendo, the thesis was really that. So funnily enough, I actually owned Nintendo at Tocqueville when the Wii came out. I remember the investment thesis back then was, they had the Nintendo DS, which was the handheld game, and that was really strong. But people had been burnt by the GameCube disaster, and so they didn't want to give the Wii any value. And so I remember the investment thesis then was that the handheld franchise, the Nintendo DS, covered the value, and you were getting the Wii for a very inexpensive price. And there was some argument that actually the Wii could be a success. So I'd been familiar with Nintendo from owning it back then. So I was when in 2020, when I read the thesis about the Nintendo Switch, I was really intrigued. And what intrigued me about the thesis was this idea that Nintendo was finally changing its kind of console plans and moving away from this, these consoles that weren't backward compatible and were basically effectively boom or bust. The idea was the Switch was more off-the-shelf components, and there were some hints that Nintendo was moving more towards an Apple type model like the iOS, wherein, iPhone, your apps on iPhone 4, or iPhone 10 would work on your iPhone 7, and there was backwards compatibility. And what that suggested to me was, perhaps we were moving away from as much of a boom and bust cycle in consoles. And what's always very interesting as well, is that the longer the console cycle, the more software you can sell into it. And that's really where Nintendo makes its money is, on its first party and third party software. And so if you removed away the boom and bust of the hardware cycle, you had a potential for a much longer and much more attractive software cycle. And the one thing that people always think about is, they think about Nintendo as a hardware company, but it's also an incredible game development. You think about the top 20 selling games in history. I forget the exact number, but a large portion of them are Nintendo titles. And the IP they have between Mario and Mario Kart, and between Zelda and all these things are this incredible IP that Nintendo fans will always be purchasing. And so you had a chance for this incredible software company to have a much longer software cycle if they extended the life cycle of the Switch. And so far we've seen that. The Switch is now the best-selling Nintendo console of all time, and there's still no concrete talk of a completely different platform, which means that we're still a few more years of the Switch, and maybe the next one will be the Switch Pro, which will be better hardware, but it will still be backwards compatible to the Switch software. And then, so that was the core of the thesis. And then the part on top was kind of the idea of there was tremendous upside potential if Nintendo could ever figure out mobile. The idea, Nintendo's IP is incredible, and various Nintendo games, whether some of their old library or newer games, would be very, very adaptable to a smartphone universe. And the debate was, would Nintendo ever really properly monetize that smartphone asset? And I thought they might when I invested, and I thought I was getting a good price on the option. When I sold the position, part of the frustration was I'd watched so like Mario Kart on mobile devices, they botched the monetization of that so badly. And it became a little clear through some of their commentary that there was at least a faction of Nintendo that didn't want to succeed on smartphones, that really wanted to just stay on consoles. And there was, it wasn't clear, but it definitely was no longer clear that they were actively going to try to monetize their valuable IP in the smartphone and kind of tablet universe. And so that took away, as I got less confident in that, and plus, so the share price had gone up as the Switch thesis had kind of played out. But my confidence in the monetization of mobile declined. And so those things together made the risk reward less attractive, and I sold.
Yeah, absolutely. That makes a lot of sense. And what encouraged you originally to begin looking at, foreign listed international companies. Was it when you started working at Tocqueville, or was it even before that?
So I was lucky enough to start my career globally. And so that gave me comfort in, looking at different filings. And I started out looking at global companies. So I was never uncomfortable there. And so I've always just kind of taken that with me to any job I've had. So even at J. Goldman, I also, owned some foreign companies as well. And, I'm a big believer if I can understand it, I don't care where it's listed. So, if it was a business that required my understanding Korean fashion trends, I'm not going to do that. I have no expertise there. I'm not going to have any advantage. But if it's a global business that has global trends that I think I can understand, then I don't care if it's listed in Seoul or if it's listed in New York. And I think that, given the globalization of business, people who focus as much on where it's listed as opposed to, okay, where does this business actually take place, are doing themselves a disservice, because, you have to understand what's going on in Europe and China on some level to understand what's happening for Apple, and so I think, we're in a global economy. We have to understand what's going on globally. And if I think I can understand the business, then I don't care where it's listed, as long as I believe that my rights, property rights, will be somewhat respected.
And so is that your advice to, I guess, the students as well? Like if they're in college today, already from the beginning, start looking also at like foreign listed companies and global companies. And if they're doing that, would you recommend they start by like, let's say, larger companies looking at, or, off the back, even look at some of these, let's say like smaller cap, mid cap, small cap, like international companies?
So my advice would be not to worry about size. It would be to start with find something that interests you. So, Graham Duncan, who's the CIO or was the CIO of East Rock Capital, has this great idea of kind of like basically find your funk, effectively. Find the thing that makes you unique and interests you, and really lean into that. And I'm a huge believer in that. I think I've seen now so many investors, and one of the things I think people struggle with is they try to fit into a box, especially young people. They fit into a box that they think makes them saleable. But I think where you actually have the ability to shine is in areas where you're innately curious. So there are businesses that are going to appeal to you and that won't appeal to me, and vice versa. And I always find the businesses that I'm just interested in learning about, I do much better research on. And so when you take a global environment where there are, thousands and thousands of companies, focusing on a company that really stokes your interest and you're really fascinated to learn more about, especially for a young person who's trying to kind of prove himself in the field, means it's more likely that you're going to be randomly scouring some Reddit feed to find some really interesting data point. That means you're actually going to learn something incremental, because everyone in the business has read the 10K and they read the transcripts and they've read the analyst reports. And so if you want to stand out as a young person, you want to show that you have the ability to find something a little bit different. And you're much more likely to do that in a business you're passionate about. So if you're passionate about electronics and high tech, lean there. If you're passionate about fashion, there's all sorts of great fashion businesses. If you're passionate about medicines, like there are so many industries that you can find companies that really innately interest you. That would be my advice for a young person kind of starting out that wants to, obviously once you become employed, you have to kind of follow the role of your employer. But when you're trying to make a name for yourself, doing those things that fascinate you because you're more likely to find that unique piece of information that no one else has, or to show that unique understanding of the business that no one else has, is a real way to kind of make a name for yourself in the industry.
Yeah, absolutely. That's terrific advice. Thank you for that. And also, what are your thoughts today on the energy sector, particularly on oil and gas?
So that's
investing in that sector.
That's one I don't generally invest in. I think obviously so much of it depends on your view of the underlying commodity. I have historically not been able to have a good view on things like commodities. So, I will never say never, but it's not a focus on mine. I'm sure some people will make some tremendous money, both on the long and the short side in that business, but it won't be me.
Yeah, no, that makes sense. And we discussed earlier some of your successes in past investments you've made. Can you discuss maybe some ones that didn't work out so well?
Yep, no, absolutely. So generally my mistakes have been where the biggest mistake is when I think you're not quick enough to realize that the thesis is wrong. So, for example, I owned a company called Easy Corp, which was a US pawn shop operator. And part of the thesis was that the CEO, or sorry, the chairman of the board at that point, the majority shareholder, had been previously caught of, convicted of wrongdoing in Delaware court. And there was no way, he cheated shareholders in the past, but he'd been caught, and there's no way he'd cheat shareholders again. During that, I learned that he was more creative than I thought. And he was able to create a way to enrich his pockets at the expense of minority shareholders. And frankly, I should have figured that out more at the beginning. That was one of those, you can wrestle with a pig in mud, but you're both going to get muddy and the pig's going to enjoy it kind of situations. So that's one. Another mistake I've made is a little bit of my comments earlier is bringing US capital markets kind of sensitivities to non-US markets. So I relatively early on invested in a company called Opus Group, which was a commercial printer in Australia and New Zealand. And they were, in my opinion, lightly levered, I think somewhere between 1 and 2 times. And so I didn't really have a concern about the balance sheet because I was used to kind of US leverage principles. I was thinking about mid-single digits, times EBITDA being reasonable. The business faltered slightly, and I think it moved up to about 2x EBITDA, and their debt holders forced a hugely dilutive rights offering on the company. And I remember when I was talking to the management, I'm like, why did this happen? You guys weren't that levered. He's like, oh, no, for our banks, two times levered was very levered. And, my mistake there was I came to it with a US capital markets framework that just was not relevant in Australia. So that's a frame of mistakes I definitely made in the past.
Yeah, absolutely. And discussing further your first example where, management, didn't act in a very ethical way. What's your process for analyzing management nowadays?
So I would say I know what to avoid. So, I'm management that is not competent or not honest, I think is somewhat easy to spot based on the way they communicate. Are there 1,000 adjustments to EBITDA? Are they selling stock hand over fist? Are there a lot of related party transactions? Do they show no ability to manage return on capital, things like that? I think it's easier to know what to avoid. I think it's harder to identify truly great management without the passage of time. I think that's one of the things that's very dangerous for generalist investors is, we move from industry to industry, and obviously we do research for a long period of time on these companies, but you're also competing with sector analysts that, even more so now with crossover funds, have known these companies since they were private. And so for me, it's easier to know what to avoid in terms of management. I know I have things that I look for that I think are good hints for what could be positive, but to get a lot of conviction that someone is a great manager takes time. And so I'm not super quick to get there and say, oh, I found a great manager really early in the process.
Yeah, absolutely. That makes a lot of sense. And overall, compared to in the past, do you believe that it is getting easier for companies to maintain their moats as a result of global scale, or harder for them to maintain their moats because of the rapid pace of technological change?
That's a fascinating question. I think it's a hard question to answer. I think on the one hand, I think for the technology companies, there are these arguments that, winner take all economics and returns to scale are massive and make them very hard to compete with. So I think in certain businesses where those, kind of scale, the old some of them like the Nick Sleep of scaled economics shared, wherein like if scale is your competitive advantage, then obviously competition will lower as you get bigger and more dominant. The flip side is that I do think the pace of technological change is continuing to increase, and I think if you continue reading some of the stuff on GPT-3 and whatnot, and GPT, the potential for AI, I think it'll only continue to accelerate. The potential for something coming out of left field, especially with all the venture cap money out there funding any decent idea, is higher. So I think where the out of left field, I think both for a certain lucky small segment of company, competition is decreasing because they will benefit from scale, and some of them are very sticky. But I also think that one of the things people may be underestimating is just the pure pace of change and the amount of funding that will lead to competitors for any business that is shown incredible economics. Any business with great economics, someone's at least going to try. They may not succeed, but they're going to try. And right now they have the funding to do it, definitely.
Yeah, that absolutely makes a lot of sense. And I'm very happy you brought up Sleep's and Zachariah's letters. I thought they were very, very fascinating. So I want to talk a little bit about shorting. And you used to short more in the past, from my understanding. Now you don't short as much. So why do you not short as much now? And when you do short, what are your criteria for shorting a stock?
Yeah, so for me, the shorting decision really came down to return on time. So I'll put 10+% in a long position that I think can go up 5x. And max I'd maybe put 4% in a short position that I think you get cut, maybe gets cut in half. And the short takes significantly more time. So I don't love the return on time of shorting when I think about the hours to the kind of absolute dollar potential of return. That being said, I am always open to shorting, and what I'm always interested in are things where I think I can magnify my risk reward without a tremendous amount of time. So for example, a short I did in the past was I thought there was an MLP that was going to miss its distribution for a variety of reasons. And so I bought some near dated puts around their next earnings date, because if they, obviously if an MLP cuts its distribution, the selling pressure is pretty intense. So, I didn't do a massive amount of work, but, and I didn't risk a massive amount of capital. So the potential to, the risk reward of the potential dollars I could have made for the time I spent on it justified it. And so that is some of the shorting I do. I will also short some for hedging purposes, to maybe remove something out of the thesis. But the pure alpha shorting I do now really needs to have those kind of unique risk reward dynamics.
And going along with that short you mentioned that did work out very well, what's a short that you've done in the past that didn't work out well?
So this was very short, Dave, but early on in my career, I remember when Tesla got added to the S&P 500, the stock was up a bunch, and I was like, oh, I should short some of this. And I shorted a little bit, and then it was going up. I'm like, why are you short? And so I lost some money on it, but really, it was just a really, really dumb trade, if we're being honest. And in a prior life, I was actually short at J. Goldman. I was actually short Volkswagen for a period, and luckily, thanks to my boss, covered just before that thing went absolutely parabolic, and so didn't get taken out on that one. But that was another really good learning thing early in my career when I still remember he looked at me, he goes, Brad, you don't know why this is going up. Therefore, it's really dangerous. And I was like, my being a fundamental analyst, I was like, oh, but Volkswagen's so incredibly overvalued, and there's no way Porsche has the corner and whatnot. And it was a great example of if you don't know who's on the other side of the table, then you're really playing a dangerous game. And in that case, I didn't fully understand all the dynamics. And so I was playing a really dangerous game. And thankfully, he kind of talked me out of the trade, because otherwise I would have been taken out on my shield on that one.
Yeah, absolutely. Thank you for sharing those. And we have some questions here about, starting your own fund. So the first is, when do you know that it's time to quit your previous job or to leave from your previous job and start your own fund?
So I would say you never are 100% ready. Even when you're been running the fund for over a decade, as I have, I'm still not 100% ready. I'm still getting better and growing and evolving and whatnot. But I think, obviously there's a lot of technical kind of capabilities you need to have, but I think where I can add a little bit is on more the personal side. So I think one of the underappreciated things of starting your own fund is that you really need to have your personal financial house in order. Unless you're one of the very few who's lucky enough to launch with a completely viable business, the first few years of launching your own fund are generally scraping and clawing and really not that lucrative. And, unless you hit the cover off the ball right off the bat. And so what I think people underestimate is the need to give yourself a long runway. So it's all great and good to say you have a 5-year time horizon, but if you need to make returns in the first 12 months to pay your rent, you don't have a 5-year time horizon. You have a max 12-month time horizon, probably much shorter. So it's really, really critical to have your personal financial house in order to actually give you the runway for success. And what that means is, you need to, have enough savings so that you can go for whatever period you think is necessary without really earning much, because in the early stages, you should not be earning much out of your fund. And again, and this is for like kind of your smaller startup fund, not a like well-seeded, really well-funded fund, because that's again a small minority. But for most people, if you're kind of bootstrapping your fund from the beginning, your take-home pay will be very small. And so if your personal financial house is not in order, then you run the real risk of, if you're down 20% in your first 6 months, the likelihood that, even somewhat subconsciously, you do something really dumb to try to get to good returns for that year that ends up killing your fund before it even gets started is much, much higher. So I think that's the one real thing I would really focus on for people is, you should make some mistakes on someone else's payroll, because you learn a lot more. You're not going to learn as much without making mistakes. And B, you should spend if it's something you really want to do, you should spend those first few years on someone else's payroll, making sure you put your own financial house in order so that you have a long runway when you choose to go out.
Yeah, absolutely. I think that's really great advice. And I imagine capital raising is very difficult as well. Any advice on that? Like, should you be looking more at like family and friends? You probably, depending on who you might need a lot of family and friends.
Yeah.
Should you be looking more at like former people you've worked with? Any advice on the capital raising portion?
So historically, that's generally been an area, again, I've not been very good at, but I will. What I would say is, initially, unless you have an auditable audited track record, it's going to be very hard for you to actually reach out to people and raise money based on based on anything you've done in the past. So generally it's going to have to be people who really trust you and trust your process, and they can be professional acquaintances who've seen the work you've done at a prior employer or the work you've done on your own. So one of the great things about the internet is you can post your investment theses on Twitter and on Substack and whatnot and really show the quality of your work. So that's one way, that's one avenue. And then, but you're going to need, those initial people are going to need to have trust because they're not going to have numbers behind them. The thing I would say, and this has been a failure of my own career, is when I started, I was very much of the, if I build it, they will come kind of, if I just do it, people will find me. And I think that was a mistake. I think there are obviously so many fund managers with similar strategies that to stand out, you either have to be willing to really go meet a bunch of people, or you have to be willing to really engage in public with your content. And obviously there are a fair amount of legal restrictions around what you can and cannot say. And I am certainly no lawyer, so don't, but there are now some structures that allow you to be more public with your quarterly letters and your communication with investors that make it easier to create a following. And I think that's important because generally people, I think if the more people who know who you are, the more people who understand kind of what you're about, the more likelihood that you're going to find those people for whom your story really resonates. And one of the challenges of a lot of smaller funds is most people may not have heard of you, and so going out to raise money, I raised a special purpose vehicle this last summer, and I remember one of the conversations was, this idea sounds great, we really like the thesis, but who the hell is Farview? We've never heard of you before. And that was because I did not do a great job earlier in my career of kind of creating more of a public presence so that everything was kind of prepared when I came with this idea for people to, people who already knew me and they were already, positively predisposed to me. So I guess, my advice would be that, if fundraising is a really critical part of what you want to do, figuring out ways, whether it's the traditional way of going to a bunch of conferences and speaking to a bunch of people, or the newer way of kind of posting more of your content online, as long as you're doing it under proper regulatory structure, so that you have a much bigger following, is probably the best way of success.
Yeah, that's really great advice. Thank you for that. And I'm just curious, why did you choose a special purpose vehicle over other methods of financing that you could have used?
So I had one position that I felt had a very unique, almost venture capital style risk reward. And it was already a very large position in the main fund. But, there are people for whom I thought, maybe the main fund isn't a great fit. But this kind of unique VC style risk reward might be. And vice versa, there are people who really want the more diversified thing in the main fund, but wouldn't want this kind of unique exposure. And so I decided that because of the uniqueness of the thesis and the risk reward, giving people the choice to invest in that solely was interesting.
Yeah, absolutely. That's very interesting. And how helpful do you think an MBA or a CFA is in the investment management industry, particularly in terms of value investing?
So I think they can be very helpful. One, in terms of signaling, because I do think that there are a lot of firms that do in some way kind of require that kind of credentialing, because what it proves is that you have the foundation in place. So from my experience, no one's going to want to teach you how to use Microsoft Excel, and no one's going to want to teach you how to build a financial model, and no one's going to want to teach you how accounting. So that's part of the reason also why investment banking is a useful route. Is it's just, based on having that on your resume, everyone believes you understand accounting, you understand Excel, and you know how to build a model. And same with, the CFA, maybe less on building a model, but everyone believes you know accounting, you know financial principles pretty well at that point. So what it does is it gives you those credentials to say, I have these basics, I have this basic foundation. You don't have to worry about that. You don't have to prove it. That being said, if you are an aggressive self-starter, it is not 100% necessary. You then just have to be very ready to very clearly prove that those foundations exist. Because I think there's plenty of people, myself included, who I'm happy to teach people the art of investing and, creating a thesis and things like that. But I am not going to spend any time with them working through, how to look at a balance sheet or how to build an Excel model. So I think those credentials can be useful, but there are ways around them. It just requires a lot more effort to prove that you have those skills that those credentials imply.
Yeah, absolutely. That makes a lot of sense. And for a concluding question, which events have been most influential in your investing career?
So I think you learn a ton from your investments. So for example, the Del Clima investment was really helpful for me in terms of kind of breaking my historical habit of, only adding to things when they're down and selling them when they're up. Conversely, so actually, when we talked about my biggest mistakes, this is so this was a mistake of omission. So there's a Swedish company called Mips. They make basically a component to add to helmets that lowers the risk of concussion. And I remember I started looking at it a few years ago, and they have incredible IP and incredible competitive position, and they were just beginning to get traction in a large TAM that they barely penetrated. And there was also a reason why it was being mispriced, because they were in a lawsuit with Canadian helmet company Bauer from the hockey helmets. And that was, the litigation expenses were basically making it look like it was not a profitable company, even though the underlying operations were pretty profitable. So really interesting thesis. And I remember I looked at it and it was trading about 50 krona. And at that point, I was a very quantitative in my risk reward, and I only wanted to buy things when they had a 5x risk reward based on kind of my view of the downside and the upside, which is silly because that view of the downside and the upside is inherently imprecise based on my own kind of estimates and inputs and whatnot. But so I was looking at it at 50, and I was like, I like it at 45. So I didn't buy it, and of course, it never got anywhere near 45, and a couple years later, it was trading north of 500 krona. So to try to save 5 Swedish krona, I missed out on a legitimate 10 bagger where I was qualitatively 100% in on the thesis. And so that was a really interesting perspective, learning experience for me on just remembering kind of what game am I playing? Am I playing the game where I'm trying to be super precise about my entry and exit points because I'm trying to clip 10 or 20% here or there, and therefore my entry and exit really matter? Or am I playing a game of, a 3 or 4 bagger, in which case, whether I buy at 50 or 45 doesn't matter as much as whether my thesis is right or my thesis is wrong. And so that was a huge, a very painful experience that was really helpful for me in terms of improving my process. And the postscript to that story is, so I live in Colorado and I participate in a lot of action sports. And of course, my ski helmet and my mountain bike helmet, as well as all of my children's helmets, all have MIPS technology in there. And there's a little yellow sticker on the back of the helmet. So every time I go to do something fun, I am reminded of that misinvestment. So it's still a painful one, but it was a really good lesson. I think it's helped me develop a lot since then. So I guess the long way of saying it is, as you work in this business, there are positions that will teach you lessons, and you just have to pay enough attention to learn what they're trying to teach you.
This was a really incredible session, and we really thank you for taking the time out of your busy schedule to meet with us today. It was truly phenomenal.
No, I really enjoyed chatting. You were incredibly well prepared, so I appreciate your efforts reading all my letters. That was impressive. So thank you so much for the time. I enjoyed chatting.
Thank you so much. Have a great day.
You too. Bye.